the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares rose today, even as global investors remained cautious in light of the ongoing Israel-Iran conflict. So the Straits Times Index was up 0.38% at 3,923 points at around 2:33 p.m. Singapore time. And that is with a value turnover of some 575 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. Well, the STI closed in the green, up 0.57% at 3,930 points. In terms of value turnover, we are looking at 993 million Sing dollars. While gainers outnumbered losers 275 versus 210. Top advances for today, we've got for you ASUS, GMHUSD and DBS. And top decliners, we've got for you Abundante, Powermatic Data and Union Steel. But in terms of counters to watch, we've got Singapore Airlines because the national carrier as well as its low-cost arm Scoot reported this 3.1% yearly increase in passenger traffic in May, which eased from the previous month's growth. Now elsewhere from the Bank of Japan keeping its interest rates steady as widely expected, to how central banks around the world are now favouring gold over the US dollar for reserves. We've got more international headlines in focus. And joining me on the line today is Jeremy Tan, CEO at Tiger Fund Management. Jeremy, welcome.
Hi, Tian Tian. Thank you for having me.
Great to have you join us on the show today. And Jeremy, let's start with global markets this time around because fighting between Israel and Iran entered its fifth day today. We've seen how US President Donald Trump urged everyone to evacuate Tehran. He cut short his visit to the G7 summit in Canada. How far has that thrown in more volatilities to global and regional equities, and how concerned are you about this?
Well, obviously, over the last few days, as the new geopolitics has played out, there is a lot more uncertainty over global equities and regional equities. Given last Friday we have seen also the VIX spiking before actually falling a little bit on Monday trading day. As with other conflicts in the Middle East or globally, I think that this could probably be quite short-lived. Given the historical precedents. However, that said, there is still a lot more uncertainty today, given that Israel's military has actually issued a warning to evacuate the country, and also President Donald Trump has also advised everyone in the city to flee. I think there could potentially be more bad news to come before some good news. I think the oil prices, even though they have normalized over Monday, but I think that there is still a lot to be seen. Even let's say if there is more supply chain disruption, especially at the Strait of Hormuz, then that could send actually potentially oil prices surging again. There is also a lot more risk for global equities, especially for those stocks or even equities that have actually exposure to the Middle East that have a lot of dependency on oil. I think these are counters that could potentially have a lot more impact. I think for companies that will actually potentially benefit will be the energy producers that have seen crude jumping by about 7% last week before stabilizing. And also I think defense stocks could see interest again by the markets, given that the rising conflicts will actually potentially boost long-term demand for its order books.
Okay. And if we go back to the Singapore stock market as usual, Jeremy, how did the STI fare today? Any surprises when we look at the biggest movers?
Well, in terms of the STI index, today it has actually done fairly well, up by about 0.3% following the strong rebound in global markets last night. I think what we have seen is that the markets are viewing that this Middle East conflict will probably be short-lived, given that in the past corrections tend to be around 5 to 10%, and they've usually follow up with a quick recovery to global markets. And today what we have seen, the biggest mover in the STI probably were the industrial sector with the likes of Keppel, Seatrium, Yangtze Shipping. I think these are names that play well to rising oil prices that we have seen. And for some names domestically, such as financials, DBS, UOB, OCBC, and some of the other REITs, I think they also have market returns given their more defensive nature amid the regional volatility.
I see. And if we could zoom in on some of the other counters to watch, Jeremy, I do want to have a look at Singapore Airlines because the firm and its low-cost arm Scoot reported a 3.1% year-on-year increase in passenger traffic in May, which of course eased from the previous month's growth. So how would you read into the latest set of numbers, and what is the outlook for SIA given the travel and tourism momentum globally, as well as uncertainties relating to the conflict in Middle East and of course oil price fluctuations?
Well, I believe that we should be more cautious in terms of the overall aviation sector for the remaining part of the year, given that there is still a lot more policy risks revolving around tariffs that will actually slow down the overall global economy. And do take in mind that the airlines or the aviation sector actually is a very highly cyclical sector that is actually very prone to volatile economic environments, and slowdowns will probably impact the aviation sector in a more exacerbated way. I think the global geopolitical tensions that we have seen recently will also impact overall demand towards some of these Middle Eastern countries, and that could reduce the overall load factors and passenger revenue factors that the aviation sector actually looks at. I think the overall, also in terms of the rising oil prices, I think that could actually increase the overall cost of running the airlines, especially airlines have a huge cost factor towards oil prices. I think that will actually, impact its margins as well going forward.
I see. Jeremy, let's set our sights on Japan because the Bank of Japan kept its interest rate steady and said it would slow the pace of reduction in its bond purchases next year, signaling this cautious approach to unwinding its decade-long monetary stimulus. Now, as widely expected, the BOJ maintained short-term interest rates at 0.5% by a unanimous vote. How would you read into the move, and how far did investors react to your expectations where the Japanese equity market as well as the Japanese yen are concerned?
Well, in terms of the Bank of Japan's decision to remain its short-term interest rate target at 0.5%, I think that actually reaffirms the cautious stance amid the overall global economic uncertainties currently that we are seeing. The BOJ currently we are seeing is actually prioritizing the economic stability over the aggressive normalization. What we have seen also, more importantly, is that the central bank has also reduced the government bond purchase taper by about 200 billion of cuts per quarter starting in fiscal year 2026. And this is down from the previous pace of about $400 billion. I think the rationale for Bank of Japan's policymakers is opting for a slower pace of substantial cutbacks in bond purchase. And this is due to the fact that what we have seen in recent months is that there has been actually a surge in interest rates in the JGB bond use, and that is actually creating a lot of volatility in the Japanese bond markets. We have actually seen the JGB bond use surging to about 3%, and this is after the extended monetary stimulus that Japan has been helping the local economy to actually prop up the economy by buying almost half of all the JGB bonds in the market. And right now, I think the Bank of Japan is actually emphasizing on more flexibility in its policies and to actually prevent destabilizing the Japanese bond market. And as a result of the actions, the market have actually performed fairly well today as well. The Nikkei was actually up because the interest rate has remained stable, and so is the yen. I think the yen has also remained stable to slightly appreciating, and I think that is actually positive, given that Japanese economy is actually highly relying on exports.
Okay. Well, if you're just tuning in, we're in conversation with Jeremy Tan, CEO at Tiger Fund Management. And Jeremy, further away, let's talk about gold versus the USD, because a survey done by the World Gold Council revealed that central banks around the world, they expect their gold holdings as a proportion of their reserves to increase over the next 5 years, while expecting their US dollar reserves to be lower. So just to bring us some context, 73 central banks responded to the survey carried out between late February and late May. 76% of these expect their gold holdings to be higher in 5 years, compared with 69% last year. Nearly three-quarters expected USD-denominated reserves to be lower in the next 5 years versus 62% last year. What do you make of the findings, and what are the levels to watch for gold amid this flight to safety for now at least?
Well, I think it's important to look at the nature of gold. I think gold, actually, during times of crisis, I think do play a strong part in terms of diversification and also inflation hedging. And what we have seen, like over the last 3 years or so, is that central banks are actually accumulating gold as a hedge against all this volatility that we are seeing in the markets. In fact, over the last 3 years, 1,000 tons of gold was actually accumulated by central banks versus 400 to 500 tons over the last decade. And this is as opposed to the foreign holdings of U.S. Treasury that is actually substantially down, given that there is actually a reduced confidence of the overall U.S. fiscal deficit situation. And overall, the dollar share of global reserve has actually declined to about 58%. And while it still remains a dominant global reserve as an allocation, but I think that over the next few years, we will progressively see US-denominated assets as a percentage of the central bank assets coming down. The global central banks will be looking to diversify further. And I don't think that this would be one that will be a sharp kind of a move away from US-denominated asset, but a gradual shift. So I think that over the long term, we should see gold and even oil as some form of a more stable asset class compared to US-denominated treasuries. And over the longer term, this asset allocation will increase. And we believe that given this backdrop, the gold prices will expect to rise further from current levels that is already elevated. We do see that by end of this year, 2025, gold could breach 3,700, and by even 2026 to about $4,000 per ounce.
I see. Well, and finally, before we let you go, Jeremy, I do want to get your take on this, because a report by the Wall Street Journal noted that OpenAI executives, they have considered accusing Microsoft, their major backer, of anti-competitive behavior in their partnership. Any initial thoughts on that?
Well, there's definitely a lot more strains and fractures between the partnership of these two companies, Microsoft and OpenAI. We do note that Microsoft has been early investor of OpenAI, backing its investments in OpenAI's research into LLM, into the artificial general intelligence AGI. I think there is a lot more to be seen. I think, of course, there is a lot of economics on the table in terms of what Microsoft could get, in terms of the OpenAI's profits. And in terms of OpenAI, I think it is wanting to transit from a non-profit company, and it actually requires the Microsoft's blessing to actually transit to a for-profit company. And it's actually requesting for Microsoft to actually give up the share of profit to be in exchange for a shareholding of OpenAI. But I think there is still quite a lot of tussle in the fact that perhaps Microsoft is not so forthcoming in terms of this. And also there is a lot more economics on how much the Microsoft will actually stand to benefit from OpenAI's server expansions. So there is a lot more, I think, economic debate on their contracts, and we will see whether that will be taken further in the months to come.
I see lots to watch indeed. Thanks so much for the insights, Jeremy. That was Jeremy Tan, CEO at Tiger Fund Management. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.